The stock market crash today is accelerating as we just got the worst Challenger job cuts report since 2009 for the month of February. And really, this puts you back in deep recession territory for planned job cuts. This comes as tomorrow we get the non-farm payrolls report. And what seems like to me is a growth scare may not be over with and may be getting ready to accelerate. In this video, I will give you all of your breaking news of the day today, major headlines from Treasury Secretary Scott Bessent, tariff news, what Trump had to say, and much more. Okay, now we have a lot of headlines to get into, but I think the big thing that is really driving markets lower as of today is the Challenger job cuts. You're not even going to believe these numbers when I tell you. Wall Street was forecasting 56,000 planned layoffs. No, we came in at 172,000. This is the highest you have been at since July of 2020. Like, remember all the layoffs in 2022? It seemed like every other day there was a big company announcing plans for layoffs. Well, this thing has skyrocketed. Like, this is something that you don't see all the time, okay? Like, look at before 2020. Like, even during some of the growth scares and concerns in, like, 2018, 2019, you only ever got up to, like, 75,000, 76,000. You're more than double that today. The economic uncertainty out of Washington is really starting to take a toll here. Here is the summary of this breakdown. It says U.S. employers announced 172,000 job cuts in February 2025, the highest value since July 2020, compared to 49,000 in January. It is also the highest total for the month of February since 2009. So you have not seen a February this week since 2009. Like, you were in a recession at this time. That is not good. Quote, with the impact of the Department of Government efficiency, DOGE actions, as well as canceled government contracts, fears of trade wars, and bankruptcies, job cuts soared in February, said Andrew Challenger, Senior VP and Workplace Expert for Challenger, Gray and Christmas. It says, the government led all sectors in job cuts in February, 62,242, followed by retail at almost 39,000, and tech at 14,000. So far this year, employers have announced 221,000 job cuts, the highest year-to-date total since 2009. I mean, you start saying 2009 too many times, and it's gonna get Wall Street nervous. And that's the part here that's tricky, because most people on Wall Street still think we're going to have a pretty good year for growth, right? That growth is going to be around 2% GDP, but not if the labor market falls out of bed. And, you know, the argument that I've made here on this channel many times is you don't just slip into a recession. You need a catalyst, okay? In recent decades, whether it's COVID or, you know, the great financial crisis or the dot-com bubble, any recent recession we've had, recent relatively in like the last 50 years, has had a catalyst. Well, DOGE, cutting back on government spending, trade war, could that collectively be a catalyst? I don't know. That's the question that I'm asking myself. And I don't think it would be far-fetched, right? As recessions are confidence issues, as people do not feel confident in their job security or confident that, you know, products are not going to go up in price, they start to pull back and they start to get more conservative, especially companies that hire and make investments, okay? They really start to get conservative. And that's what causes recessions. When people stop spending as much, companies stop hiring. It's a feedback loop. Could this be a catalyst for a recession? I mean, I don't know how you get through this, you know, without some pain. Just look at the spike here. This is very recessionary. outside of recessions, you really don't see this kind of thing happen. I mean, these challenger job cut numbers are essentially about the same as where you were during the peak of the 08-09 recession. Okay, you did really peak in January of 2009. You had 241,000, but before that, in January of 2008, you had 181,000. And then in January 2009, you had 186,000. So really, I mean, you're at the same levels as the global financial crisis. You're at roughly the same levels that you were at during the implosion of the dot-com bubble. I mean, this is not good, to say the least. And honestly, I think you need to hear the recession word floating around more after this data. Now, tomorrow's data is really going to confirm this to us. And I told you yesterday that I was concerned about the Friday jobs report. Why? Well, because we're only expecting 20,000 government layoffs. Challenger job cuts reported over 60,000. That is going to be, proven to be way too conservative. Okay, and then did the private sector make up the difference? I don't think so. You're still sitting with an estimated negative 20,000 print for government payrolls. And the headline non-farm payrolls number is expected at 160,000. I mean, that would be better than last month. I don't see how that would be possible. Okay, and we could have a very bad number tomorrow morning. And I think that could, again, kickstart a lot of those recession fears. Now, at the same time, you have this quote-unquote inflation problem. At least from the Fed's perspective, the Fed doesn't really want to make too big of a move before they know how inflation will be affected by tariffs. Mix this together, and you have a shitstorm that is brewing. On that note, U.S. Treasury Secretary Bessent says, I hope the Fed team transitory regroups on tariffs. Basically saying he hopes the Fed starts to say tariff inflation will be transitory. Like, they're not going to make that mistake again. That is, that's optimistic thinking there, Bessent. The odds of an economic downturn has climbed to 31%, per JP Morgan. It was only 17% in November. Secretary Bessent says tariffs can be a one-time price adjustment. Key word, as a lot of people point out, can be, but not guaranteed to be. U.S. Treasury Secretary Bessent says April's reciprocal tariffs will be a path that is dependent on our trading partners. And Canada's Prime Minister Justin Trudeau says Canada-U.S. trade war to persist for the foreseeable future. So there was a lot of hopes that maybe there was going to be a concession, maybe tariffs would be lowered and this drama would be over with. And Trudeau came out this morning and says, yeah, there's really no end to this in the foreseeable future. That's also what negatively impacted markets today. And Donald Trump will be signing executive orders at 2 p.m. It is around 2:10 at the time of recording this video, so some of those are coming out and it looks like markets are trading lower. With the S&P that is now down over 2% on the day today and testing this 200-day moving average. And, well, this is critical, guys. If we do not bounce here, things are going to get a lot worse, okay? And we'll talk about that in a few moments. But before we do that, it is worth mentioning that SPY put volume spiked yesterday to the third highest in history. Previous two spikes were bottoms for the S&P 500. QQQ put volume made a new all-time high yesterday. And I do think we are due for a bounce, but I don't think we're heading back to new all-time highs anytime soon. I think the volatility is here to stay. And I think we have more recession risk to price in. Okay, unless the trade war ends pretty soon here, the economic situation is not going to get better. And Wall Street is way off sides right now. Most of Wall Street, again, is expecting a pretty good year this year for corporate America, for GDP. What if, recession odds are rising, which logically speaking The data says they are. We're not priced for that. Okay, given the last 2 years of, rallies in markets, we are not priced for a recession in the slightest bit. I think to even get back to pricing in, a mild chance of a recession, like a 40, I shouldn't say mild, wrong word there, but like 40-50% chance of a recession could bring you down to 460 on the SPY. That is where your 700-day moving average is. That would be a peak to trough decline of around 25%. Now, are we guaranteed to crash further from here? Absolutely not. But if the data continues to show a recessionary dynamic, pretty soon people are going to start pricing that in. And I don't think you have priced that in yet. And that is where the further downside comes in at this point. Again, couple that with the Fed that's really not able or not willing to accommodate markets with the threat of tariffs causing inflation, and you have a shit storm that is brewing. There's really no other way to put it. U.S. Treasury Secretary Bessent says, notice Trump has stopped calling for the Fed to cut rates. And he basically went on to say over the next couple of minutes during his speech that they're trying to lower deficits, and that's how they're trying to bring down 10-year Treasury yields. They're not trying to pressure the Fed into cutting rates because clearly that's hasn't been working. U.S. Treasury Secretary Bessent says we want to focus on 10-year yields and what can the administration do to bring that down. Bessent says incomes from tariffs could be very substantial. But again, keep in mind, tariffs are paid by U.S. companies. They're not paid by Chinese companies. They're not paid by Canadian or Mexican companies, like Nike, for an example. Nike, as they import products that they're produced from China, Nike has to pay a tariff. What is Nike going to do to protect margins? Well, they're probably going to fire people, okay? That's why I'm not super concerned about tariffs causing inflation, but instead tariffs actually hurting the economy. It's a tax on corporate America. And I know what some of you guys are going to say, tariffs bring back jobs. And of course, over the long term, that's true, but there's a short period of pain. Short, I mean like a year or two, relatively speaking, that's a short amount of time, where things could get painful if these tariffs go into effect and stay in effect. Trump says that he had a positive meeting with agency secretaries and Elon Musk, instructing these secretaries and leadership to work with Doge on cost-cutting measures and reducing staffing. And Trump says we will have Doge meetings every 2 weeks. Trump's special envoy, Witkoff, says Trump is listening intently to European allies. And all of this volatility that we have seen recently, I mean, no tariffs have been impacted or put into place on Europe. I mean, that's another step of this that we will get April 2nd. And the S&P 500 today briefly falls below the 200-day moving average for the first time since November 1st, 2023. U.S. Treasury Secretary Bessent says we must revise our tariffs with China. I don't know what that means. If he suggests that tariffs are too low or if they're too high, but it doesn't seem like it was taken well by the markets when he said it. Mexico's President Sheinbaum says Mexico imports a lot from China. We don't have a free trade deal with China. And one of the biggest pieces of good news today is Mexico's President Sheinbaum says very likely that portions of USMCA agreement will start being looked at before the 2026 review. It was also reported today that any products coming in through the USMCA will not be tariffed. And Mexico's President Sheinbaum says that virtually all trade with America goes through the USMCA. Now, for anyone that is curious what the USMCA is, it is the United States-Mexico-Canada Agreement. It is a free trade agreement that aims to increase trade and investment between the three countries. Secretary Bessent says that tariffs are not regressive if they fund no tax on tips. I mean, I don't agree with that. I think tariffs are regressive for the U.S. economy, regardless of what you do to offset that. It is a tax on corporate America. Bottom line, long term, we should have either no tariffs anywhere or equal tariffs. I agree with that. But slapping on tariffs on a system in which we have not had these tariffs is a new cost. I don't think that cost can be passed on to consumers, so it's essentially a tax on corporations. Treasury Secretary Bessent says a lot of the affordability crisis is due to high energy prices, which I do have to agree with. And Bessent says the US does not have a revenue problem, we have a spending problem. And here you can see Trump said no tariffs on Mexico for USMCA goods, which, as Mexico's president said, is basically all of the trade that takes place with America. And Trump says Canada's Prime Minister Trudeau is using the tariff problem to run as Prime Minister again, which really, kind of shows we're not really making any progress in reducing the tariffs with Canada. Trump threw a pretty big jab at Trudeau today. Now, what is also pretty alarming about today's sell-off, SPY's down 2%. Obviously, it's a rough day, but if you look at TLT was not having a good day for a majority of the day today. But as the market started to sell off, you got more of this fear bid. People started to rush into bonds as the markets were selling off. And if tomorrow's data with non-farm payrolls and the other data sets that we have are also bad, you're going to see people rush into bonds. Okay? That's not normally great for stocks. And I do think as the economic data worsens, that's going to put a lot more pressure on equities. Because again, if you think we're priced for any moderate chance of a recession when you're only down roughly 7% from all-time highs, think again. You're not even close to price for a recession. Now, do we need to price for a recession? Obviously, not all the way at this point, but should there be some odds of a recession priced into markets with the data that we're getting? Probably. And if the data continues to get worse, that's where recession odds are going to rise and equities are going to fall. That's why tomorrow's data is going to be critically important for investors. And again, unfortunately, I don't think a weak jobs report is going to be good for markets because nobody thinks the Fed's going to run out on the first bad jobs report and start cutting rates again because of the tariff situation. So it's like we're just kind of in limbo here where we're just vulnerable to whatever happens. And it is opening the door for a policy error by the Fed. Now, here on the day today, the Dow is down 566 points, down 1.32%. S&P is down 2.13%. NAS is nasty today, down almost 3%. The Russell 2000 is down about 2%. The VIX today is up almost 17%. But what's also kind of alarming here is you're not getting the panic yet. This to me does not seem panicky. Okay, this does not seem like an all across the board sell-off. Like Dollar General was green today, up like 2%. Usually when you're actually bottoming during a correction, you see everything kind of sell off. And you're not getting that at this point. And the VIX sure is up 17% today, and it is high at 25.65. It's still not panicky yet, like we've seen at other correction lows, which, again, suggests that maybe we have more downside left in store. Like December 18th, when we marked the low after the Fed, the VIX opened at 15 and it ended at 27. Okay, today, the VIX opened at 22 and it's at 25. Like, sure, the VIX is going up, but it's not skyrocketing. When the VIX skyrockets, that is going to mark a more lasting bottom in markets. We did get a new AI investor sentiment survey that just came out in which, it's interesting. Bearish investors fell from 60.6% to 57.1%. Neutral investors rose from 20.0% to 23.6%, and bullish investors actually fell from 19.4% to 19.3%. So people are not feeling good out there. These are some of the worst numbers you have seen in ever. Like, when people are this bearish, normally you're deep in a bear market, like S&P down 25+%, and you're still sitting at those very fearful levels. And again, the CNN Fear and Greed Index today is at 17. Yesterday, it was at 21. Market momentum, extreme fear, stock price strength, extreme fear, stock price breadth, extreme fear, put and call options, extreme fear, market volatility, extreme fear, safe haven demand in extreme fear, but junk bond demand in extreme greed. And that is what makes the CNN Fear and Greed Index not look even worse. If that junk bond demand starts to fall, then you're going to have a CNN Fear and Greed Index in the single digits, which almost never happens. 8% of stocks trading above their 50-day moving average today, falling to 28.33%. About 4.5% of stocks are breaking below their 50-day moving average. So you're getting down to the lower end ranges that you see during corrections. Now, this is contrarian, I would say, a bullish indicator, at least short term, to get a bounce in markets. But again, I really think it's going to come down to the data that comes out tomorrow. If we get a bad jobs report, I think markets are going to sell off a little bit more on that. If we get a good jobs report, some of the growth concerns slow down, and maybe we're safe for a little while and can actually go through a bounce here. Now, normally you bounce at this 200-day moving average on the SPY, but sometimes you need to fall below that for a little bit. Like you've seen back here in October of 2023, you hit the 200-day moving average. You proceeded to fall another, what was this, like 3% or so? Yeah, 2.5% below your 200-day moving average. So pretty soon you should be getting a bounce, but it may not be right at the 200-day moving average, which is pretty much where we are now. Let's say we do fall another, 2.5% or so below your 200-day moving average. That's going to put you back to about 555 on the SPY, which from all-time highs, that would mark a correction of about 9.5%. So maybe that's where we need to hit. Although, I guess your guess is as good as mine in this market environment. So let me know what you guys think about this down below in the comment section. This, by the way, would put us back to where we were in September of 2024. Like, we were just here a couple of months ago, which is the craziest part about this sell-off. Like, we're not hitting multi-year lows. We're like hitting multi-month lows, which is just wild. Okay. Kind of a scary thought when you think about it like that. Nonetheless, thank you for watching. Enjoy the rest of your day. Ladies and gentlemen, I hope you are feeling good out there, buying the dip, hedging portfolios, whatever you're doing. Let me know what you are doing down below in the comment section. Have a great rest of your day, and I will see you in the next one.